Cigna Group is a classic example of the type of company that I believe long-term investors should strive to own. We're looking at adjusted operating earnings here, and I want you to notice that earnings trend has been up over the last 20 years, averaging over 12.29%. There is the occasional down year of earnings, but in the long run, the company's earnings have grown very consistently over time. And as an investor, that's what you want to look for, companies that can produce solid operating results year after year. Also note that in 2020, the company started paying their first dividend, and that dividend started out at $4 a share. Now, prior to that, they did pay a minuscule dividend of around 4 cents a share, but they really didn't get serious about their dividend until 2020, and they paid $4, and they raised it to $4.48, $4.92, and expected to do $5.02 and $5.42 in the forthcoming years. When you put price on the graph, you can see that in the long run, the stock price has gone where the company's earnings have gone. There's always going to be short-term volatility, which is quite unpredictable. But in the long run, the price is going to follow earnings. And with fast graphs, you can evaluate what multiple of earnings becomes a reasonable multiple for you to buy, sell, or hold the stock.
Hey everyone, we are offering 25% off your first payment when you sign up or upgrade to Premium Annual. This is only valid for new users and upgrades to our Premium Annual product. Use promo code BANKING9 in your checkout to claim this offer.
Hello everybody, this is Chuck Carlisle, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And what I've got here is part 2 of a subscriber request series. I call these Analyze Out Loud videos, where I simply go through a group of stocks that you subscribers have asked to see. I can't, because there's so many stocks in a group like this, I'm not going to be able to evaluate each of them really thoroughly. However, just thanks to the magic of fast graphs, you can clearly see whether or not there are stocks that you should be buying or not, or even should be researching further or not. That's one of the great benefits of fast graphs. So let's go ahead and get into the stocks now. I've got 28 to cover. I'm going to cover them again. These are Analyze Out Loud videos. I'm going to just scratch the surface of what you should do, but the primary objective here is for you to look at a fast graph and say, is that a kind of company I would even want to own or not? That's one of the greatest benefits it offers. The second is it at a price point today that makes sense for me to be investing in it or not? Or should I be looking for a better entry point? Or should I even be selling the stock if I own it? So starting out with Cigna, as I mentioned in the opening remarks, the company's had pretty consistent earnings growth. The stock price has tracked that. The orange line represents what I call the valuation reference line. That's when the stock is trading at a value that reflects the fundamental strength of the business. When the price is below that orange line, it would indicate that you can buy it at a bargain. When the price gets above that orange line, that would indicate that the price is trading at a level that's higher than the real intrinsic value of the company. And I want you to notice that in the long run, that works out very well. The correlation is very high, but never perfect. But when it gets overvalued, it typically comes back into fair value. When a stock gets undervalued, it typically begins to move back into fair value territory. Sometimes it happens very, very quickly. Sometimes it happens over a period of years. But the point is, I always trust fundamentals, the orange line on these graphs, more than I trust the black line. So let's go through these 28 stocks very quickly. The first here is Cigna, offering a 1.87% earnings yield. It's trading at a discount to what I would consider its intrinsic value, and also a discount to the multiple that the market has, a discounted multiple that the market has usually applied. This looks like an attractive buy today. Now, one other point I want to make when you're looking at a growth stock like Cigna, if you run different time frames, notice the growth rate here is 12.29%. If I drop that to a 15-year graph, the growth rate is 13.7. That's really a very similar, or certainly a very close number. That's meaning this company has been growing at double-digit rates. I drop it to 10 years, and I'm going to get a different growth rate again, where I can make a judgment of whether or not the stock is continuing to accelerate or not. If I drop it to 7 years, I get a lower growth rate, but I'm still in the double-digit rate. So what I can say with this company is it tends to be a double-digit grower, but I'm going to use that to help me determine what's happening to the company over the long run and how the company has performed historically over the long run. But in reality here, what I'm looking for is I'm looking for companies that can give me some consistent rates of return over long periods of time. All right, that's really the key point that I'm looking for. But when I'm making my buy decisions or sell decisions or hold decisions, I'm always going to do it based on what the forecast looks like. Now, 11% forecast is in line with the company's historical achievements. So in other words, you could say it's more of the same, perhaps a little lower than normal. I can go into historical growth rates here. I've got several forecasting tools, and I can see for the last 5 years, the company's actually averaged 17% growth. But I've got a drop-down window here, which allows me to look at the different levels of growth that the company has achieved over all these years. That's why I call this a tool to think with. And double-digit growth is, clearly what this company has offered. From a standpoint of current expectations, I think 11% might be a reasonably conservative number. And if I real quickly check the analyst scorecard, the analysts have been right on this company most of the time. And, that's really kind of gives you confidence that perhaps the estimate graphs might make some sense. I can almost guarantee you they're not going to be perfect, but they might make some sense. But anyway, that's the first company on the graph, Cigna. So let's move on. Let's look at Carlisle Corporation here. Now, Carlisle, like Cigna, is a company that had pretty consistent growth. But if I use my scroll bar here, I'm trying to figure out what I'm seeing. Instead of the 13.56%, I get now an 11% growth rate with moderate cyclicality. But again, I get a price that tracks that very closely. Now, recently, we've had this surge in growth over the 2021 and 2022, expected to have a down year in 2023, and then followed by some growth years going forward. The stock looks very inexpensive on that basis. Again, I can go through the machinations of changing all these time frames to give me a different perspective, but ultimately, I want to look at the forecasting graph. Now, we're going to have a negative growth rate here. We have an average growth of 3.69, but let's think about that. That includes negative 8.65 this year, but then we're going to be looking at 11% and 8% after that. So this could be a really good time to be taking a position in Carlisle if you're a long-term investor. The company offers a dividend yield of 1.42%. It's BBB rated, has 40% debt to capital, and looks, attractive at today's levels based on not just historical growth, but more importantly, what the future growth rate for earnings looks at. Now, by the way, when I'm going through companies like this, I'm also going to look at other metrics. I'm going to look at things like EBITDA. I find EBITDA, if the company has EBITDA, a lot of financials don't because of the interest component of EBITDA, earnings before interest, taxes, depreciation, and amortization. I get some really nice correlations with EBITDA. EBITDA can really help guide me in making a decision where I should buy, sell, or hold. But I've also got other metrics like price to sales, etc. People often ask, which is the best one to use? My answer is, look at all of them and try to put all these pieces of the puzzle together to help you make a learned decision, because that's the advantage of the fast graph. The next one is CTO Realty. Now, this is a diversified REIT. So the first thing we want to do is we want to convert that to operating cash flow. Now, I don't really understand, this is called funds from operations, what was going on in 2017 and 2018. So the first thing, by just glancing at this graph, brings up questions here. The stock didn't do very much during those years. In fact, it had really a negative rate of return for all these years. I take that into consideration, what was going on with the company, what's different about it today. More recently, we started to get some consistent growth, but forecasting growth is only expected to be about 5%. It does offer a very high dividend yield of over 9%. It does offer a funds from operation yield of over 9%. So this could be attractive. It has no credit rating, reasonable amount of debt for a REIT. But again, I would have to look at a lot of other aspects of this company and dig a lot deeper before I'd be interested. EBITDA is also a good metric to look at when you're looking at REITs that can give you some good insights into, how the business itself has performed. And of course, you've always got sales or revenues to look at to check how a business works. Okay, the next company we're going to look at is Danaher. Now, this is a very interesting one because what you have here is what I consider to be a really super company. Notice that it's A- rated, has a very modest debt of 25%. Now, it doesn't offer much in terms of dividend yield, but that's because we clearly see that the price is really high here. But now Danaher, if I take price off of the graph, it's the kind of company I want to own. It's got really strong and consistent growth. It's had a few blips, which, again, most companies are. The market does tend to put a premium valuation on this stock, but the premium valuation has been much more so over the last several years. And this is an area where interest rates have been rising, where, the theory is many people think valuations are going to go down. If I look at it from a standpoint of EBITDA, I feel like I get a much better valuation metric, but still tells me the stock is overvalued, but it's coming into fair value. It might be a little early, even though we've had a nice correction in Danaher, it might be a little bit early to be taking a position in this extremely high quality life science tools and services company. The next one is a utility stock, electric utility. I don't really know much about this company. When I look at it from a standpoint of operating earnings, it's kind of got a very cyclical history. I don't really trust. There's been a lot of volatility in the price. I think the stock, regardless of all that, is overpriced today, and it's not one that I'd be interested in looking at today, mainly because I think the valuation is too high. But the point I want to really stress home here is that I can instantly get that perspective just by looking at the fast graph, one of the powerful things it offers. Estee Lauder is, personal care products. Everybody, is familiar with them. You can see they've had decent growth. The market likes to put a premium on multiple on the company's earnings. If I do look at EBITDA, earnings before interest, taxes, depreciation, and amortization, I see this very strong correlation that basically deviated starting in about 2019 or so. The stock got really overpriced. You can see the price is coming into fair value again, but I don't believe it's quite there yet. It's A+ rated, has 44% debt, offers a 1.3% dividend yield, but I believe that yield is artificially low because the valuation is artificially high. The next one would be Energy Transfer LP. It's BBB- rated, offers a dividend yield of 9.8%. With a company like this, mainly be focused on the dividend, I'm going to be looking at operating cash flows and whether they cover the dividend or not. And they do. This isn't a really great capital appreciation stock, I want you to notice. If you compare it to the market, it's actually underperformed the S&P 500 on capital appreciation, but it's produced significantly more dividend income and actually outproduced the S&P over this time frame on a total return. So if you're an income investor, this would be a unique situation for those of you who are interested in investing for income. Might want to take a look at Energy Transfer. Fabrinet is an electronic manufacturing services company. It's actually a pretty interesting growth stock. If I look at adjusted operating earnings, it's had pretty consistent growth. And again, if I manipulate this a little bit and take some periods out, it's got, I'm going to say 10 to 15 or 20% growth rates. The stock price is somewhat volatile. It's relatively inexpensive on that basis today. Expected to grow at 13%, trading at a blended PE of around 12.5. But this is a pure growth stock. Company has very little debt, which is a plus. It does not have a credit rating, though. So this is strictly for the investor who's looking for capital appreciation, and they're looking for a stock that's got good growth potential and good value. But again, you can look at the fast graphs and instantly see what kind of animal you're dealing with here when you look at a stock like Fabrinet. Great television. Now, here's where fast graphs can really earn its keep. If I look at it fundamentally, dividend yield of 4.9, we'll call it 4.5%, trading at 2.5 times earnings, massive earnings yield of 39%. But when I look at this stock and look at its earnings record, it's all over the place. But look at the price record. Look at the price. If I just run it, for a long-term record here, it has a negative rate of return over 18 or 19 years here. You can just look at the price of this stock and see that it's gone nowhere, and that's because I think the fundamentals are so poor. Now, you can look at this stock through a lot of other metrics, and again, EBITDA gives you a little better forecast. It does look very, very inexpensive, but I think you're looking at something that's very speculative. It only has a B+ credit rating. It does have a rather large amount of debt. If I look at it from a sales point of view, the company has decent sales growth. But again, the inconsistency here would be something that I personally would reject as a long-term investment. And it certainly hasn't been, up to this point, over the last 20 years at least, a good buy and hold investment. Next, we're going to look at Honeywell. Honeywell, based on earnings, looks massively overvalued. If I look at it from a standpoint of EBITDA, I see that the correlation has been very strong, but just recently it's gone overvalued. You can see a lot of volatility with the stock price going nowhere. I think the stock is overpriced today. I like Honeywell. I'd like to own Honeywell, but I'd have to be buying it, at a much, much lower valuation, $115 to $30 a share, before I'd personally get interested in Honeywell. But it is an A-rated company with 41% debt. It does offer a 2% dividend yield. The problem is the stock is too expensive. And Fast Graphs gives me that perspective virtually instantly just by looking at the graph. International Paper, you can't really call this a growth stock. It's had 4% growth, but it's been very, very inconsistent. And you can see the stock price has been very inconsistent. Not a buy and hold stock. It's got good metrics from the standpoint of a 5.75% dividend yield. It is investment grade, BBB rated, has less than 50% debt. But again, I don't think this is a long-term, I'll make a lot of money. If you look at it over the last 6 or 7 years or so here, you can see that the stock has virtually, including dividend income, not reinvested, but including dividend income, has not made you any money. So IP is an industrial paper and plastic packaging company that I don't believe grows very much. What you can say about it, it's got a good current yield. It's probably relatively cheap, doesn't have a lot of downside, might have a little bit of upside, but I wouldn't call this a long-term hold stock. Leggett Platt, I could say almost exactly what I said about International Paper. The stock doesn't grow very much. You can see the price volatility, and the price is tracked. It's currently, might even be considered pricey relative to its fundamentals. It's not massively overvalued, but fundamentals do not look very promising over the next year or so. So I would reject this company here, even though it offered over a 5% dividend yield, even if you're an income investor. Lincoln National did an article on it. It was one that I was asked to look at. I want you to notice this huge collapse in earnings here. The stock has continued to drop since I did the first video, but it's only been 6 months. And what we're looking at here is a strong recovery. And if you're a speculator, that recovery would indicate that there's an awful lot of return potential long-term in buying this stock today, assuming that it, explodes back into this, what I would call more normalized growth rate. So this could be one that would be interesting to speculate in. Does offer an 8.5% dividend yield, which is very nice while you're waiting, but this is a speculation. This is not a buy and hold long-term investment. Louis Vuitton here is an interesting one. Earnings-wise, the correlation is decent, but the market likes to put a premium using that EBITDA metric again, which I think is so important. You can really see the right time to be buying, selling, or holding this stock. Right now, I think it's overvalued, just like it was, in 2021, and it corrected. But if you could buy this stock at or below the orange line, it might be attractive, but I don't think it's attractive today. All right, but it obviously is a good company. It's AA- rated. It only has 25% debt. So it's one that you could, look at when the price corrected. Mid-America Apartment Communities, if I'm looking at it from EBITDA, it looks overpriced. If I look at it from a standpoint of operating cash flow, I would still argue that it's moderately overpriced, but you can see how overvaluation resulted in very poor performance over the last year and a half. And it's still one that I think would have to be cheaper before I'd be interested. But I do consider it a very excellent REIT. It's A- rated, has very low debt for REITs as they go. I just consider it a little bit expensive right here. But it's one you might want to watch for. If it keeps dropping, you might want to pick some up when it gets into fair value. McDonald's, looking at it from a pure operating cash flow point of view, the stock looks overvalued to me. If I look at it from an EBITDA point of view, the stock looks overvalued to me. If I look at it from a standpoint of adjusted operating earnings growth, the stock looks overvalued to me. It's an excellent company. Obviously, everybody knows McDonald's. I just don't think it's a good time to be buying the stock at this level. 3M is coming into really attractive buy. The market usually puts a premium valuation on this stock. If it does go back to that premium valuation, it's an incredible opportunity. The price to EBITDA on 3M is very, very fascinating because you can see how, bad time to buy, good time to buy. You can see that the stock price has followed EBITDA over the last couple of years. And there were some issues, and I've talked about this in previous videos, but it is expected to recover. And this could be a great time to be buying this company with almost a 6% dividend yield, trading at 8.5 times earnings, A-rated, 42% debt. I like 3M a lot here. Banks don't have EBITDA, but this is a regional bank. And again, just by immediately looking at the fast graphs, we've had virtually no growth. We've had no price appreciation. There's something going on right here I think you could look into, but I would call this a speculation. I wouldn't consider this a good buy and hold stock at all. But fast graphs tells me that immediately. One Liberty Properties is a diversified REIT, so I'd want to look at that from a standpoint of operating cash flow. And I would say the stock looks probably attractive here, assuming that the FFO does grow going forward, although it's not expected to give you much growth. The real allure here is the dividend yield of over 9%, could make double-digit returns. If the stock reverted to about a 14 or 15 PE, it could be very, very attractive at these levels. The next stock I want to look at is Prologis. This is a kind of an interesting growth stock. You can see it kind of got hurt by the recession. It's an industrial REIT. If I look at it from a standpoint of funds from operations, it looks very expensive, but watch what happens when I shorten the time frame. You can see that I get, significantly different growth rates. I just think this stock is expensive today, and I wouldn't be too interested, even though it's a good quality REIT. Pool Corporation is interesting. This is where you really want to look at different time frames. I'm looking at it from a standpoint of operating cash flow here. Let's look at it from a standpoint of operating earnings. Earnings growth has averaged over 15%. But watch what happens when I change the time frames. Growth rate, since 2011 has averaged over 20%. The stock got really overvalued, but it had some really strong years that kind of justified that valuation. The stock is now getting to where it looks a little bit cheap. If I look at forecasting, though, we're not expecting any growth, and that would be something I would really have to validate. If this company isn't going to grow any faster than what current expectations are, even though it might look cheap here, it doesn't look cheap as a long-term investment. PayPal is a classic example of a hype stock that was massively overpriced. It's now maybe reasonably priced for the first time since it was a public company, and it might be a decent growth stock with a 15 to 20% growth going forward. But again, it's pure growth. There's no dividend looking at PayPal here. The next stock is Roper Technologies. This is another case of a stock that the market likes to put a premium valuation on. I don't know why it does that. I just know it does that by looking at it. And this is where I think things like the price to EBITDA becomes a much better metric for you to evaluate a stock like this on. So let's go ahead and look at it from a standpoint of price to EBITDA. And we see that it was very, very nice correlation, but recently got overpriced and become more volatile. It does look expensive today. The next one would be Silicon Motion Technology, a semiconductor, very cyclical stock, but you can see the price reacts to that cyclicality, is expected to have a drop in earnings and then a recovery. Looking at it, this is EBITDA. Looking at it from an EBITDA point of view, I think you'd be looking at a speculation here. If we look at this stock, again, from the standpoint of operating earnings, we would see a very similar picture to what we see with EBITDA. I think Silicon Valley is probably too expensive and too cyclical to attract me at these levels. The next stock is Synopsys. I think Synopsys is a great company that's massively overpriced. That would be my, quick take on it. From a standpoint of EBITDA, you can see how it traded at a normal 18 times EBITDA and is now trading at over 30 times EBITDA. Great company, just too expensive. American Telephone has no growth. It does have a decent dividend yield, and it does have recovery potential. But again, it is what it is, and by looking at the fast graph, you can see what the company has been and what it's offering just instantly by looking at the graph. Teradyne, somewhat semi-cyclical growth. It would be a turnaround situation, not much in the way of dividend yield. And then, last but not least would be a regional bank, Truist Financial. If I look at it over a short time frame, it's about a 5% grower. It's had flatline growth in the last 3 years. What this stock has going for it is extremely inexpensive with a high dividend yield, and it is an A-rated company. So if there was going to be a time to buy the stock, it might be now. Anyway, this has been Chuck Carlisle, co-founder of Fast Graphs, aka Mr. Valuation, doing an Analyze Out Loud video on 28 stocks that you asked me to look at. I hope you get the idea of how powerful fast graphs are. They can really show you in an instant whether or not a stock is attractively valued, what kind of performance it's had historically, and more importantly, it gives you some guidance on what you might expect in the future as well. And it's a great first step prior to a more comprehensive research and due diligence. If you like this video, give me a like, ring the bell, subscribe to the channel, and I'll be seeing you real soon. This has been part 2 of the Analyze Out Loud video that was actually where I had subscribers asked to see stocks back in May 1st. Thanks for watching. I'll talk to you guys again real soon.